So CloudMD reported record fourth quarter 2020 revenues on track for significant growth in 2021. Looks like Q4 revenues were $5.8 million, up 138% compared to Q4 2019 and 73% compared to the prior quarter. So it looks like they grew their revenues by 73% quarter over quarter, which is unheard of. But that's mainly because they did a lot of acquisitions, so that really helped them increase the revenue significantly. So essentially, they bought their revenue to be able to increase it by 73%. Gross margins, though, they were over 40%, which is pretty decent. It's in line with what WELL Health does as well. They have a strong balance sheet right now with current cash positions of approximately $100 million. So that's a lot of money that CloudMD has in order to use for future acquisitions and to be able to expand their business through buying revenue as well as cross-selling products. They've got a fast-growing enterprise health solutions division, which currently has a revenue run rate of $53 million. So I'm not really sure when this $53 million revenue run rate was for, because they only had revenues around $5.8 million. So I suspect that this revenue run rate is only accounted for in next year's revenue, and maybe they squeaked out $1 million or $2 million from the EHS division. So we'll see later on down the road if we can see more detail about that. They continued to grow by adding over $92 million in annualized revenue already in 2021 through strategic M&A. So basically in the past 4 months or so, they've added an extra $92 million or bought an extra $92 million of annualized revenue run rate. They have strong 2021 expectations with annualized revenue run rate exceeding $120 million. So basically I expect by December 31st, basically they're going to earn about $30 million per quarter. But for the time being, the revenue run rates does sound exciting. So potentially, I believe the stock might have a little boost tomorrow. Looking into some more details about the fourth quarter, we can see that gross margins were 40% compared to 44% last year in 2019. So the gross margins dropped down. However, this is just due to reclassifying certain expenses. So it's a bit of an accounting thing that happened here, which caused the gross margins to drop. They still continue to run a net loss, and the net loss was around $5.2 million or 5 cents per share, compared to $1.5 million or 2 cents per share in Q4 of 2019. So their loss continues to widen this year. Looking at the fourth quarter, CloudMD was very busy. They had a ton of acquisitions close, changed some directors up, as well as they did another financing deal for about $37.3 million. And that financing was oversubscribed, meaning that there were a lot of people or a lot of banks and institutions who were interested in subscribing to their bought deal financing. CloudMD also highlights things that happened after the quarter. So it looks like in the past 4 months, there's still quite a bit of activity. A lot of this was just announcing certain closings of acquisitions, as well as another financing round of about $58 million. Now, the most interesting thing here today I want to talk about is their outlook. So as investors, we're always looking for a company to become profitable. And CloudMD says the company is on the road to profitability and expects to be adjusted EBITDA positive starting Q3 2021. So they're not going to have positive net earnings per share. However, their adjusted EBITDA will be positive, or they're hoping for it to be positive in Q3 of 2021. This is already the first step in the direction of having some sort of net income or positive cash flows. So down here, CloudMD has their definition of adjusted EBITDA, and it refers to earnings before interest, taxes, depreciation, amortization, share-based compensation, financing-related costs, acquisitions and other related costs, net of litigation costs and loss provisions, change in fair value of contingent consideration, and loss from discontinued operations. Here's a chart of their adjusted EBITDA, and the one thing that I want to point out here is the fact that their net loss for both the quarter as well as the year is growing faster than their adjusted EBITDA. Some of the biggest expenses that have occurred over the year are the litigation and loss provisions costs at 7,400%, as well as the financing related costs at 1,000%. But financing related costs is probably due to all the different equity raises that they had to do, which is not normal for a company unless they're in this hyper growth phase. But CloudMD ideally doesn't want to rely on financing going forwards in the future. The goal is to get to positive EBITDA, positive cash flow, and use those cash flows to be able to fund acquisitions. And I believe they're taking these costs out from their EBITDA because they're not a fair representation of the company year over year. These costs are sort of like one time or one-off over the years, and it's going to change from year to year. It's not predictable or it's not like recurring. So that's why they have an adjusted EBITDA that discounts all these different costs. Another interesting fact here is the company has already seen over $5 million in organic revenue growth since January 2021. So I believe this means that they've seen organic revenue growth basically since the beginning of this year up to April right now of $5 million. So that revenue run rate that they're giving of $120 million might be actually $125 million based on this organic revenue growth added to the 120. And they've also seen cost savings of over $500,000. So basically they've cut some of their expenses, probably just by like laying off certain people or having people leave after some sort of acquisition. The layoffs are mainly to reduce like redundant staff. For example, like the HR team or the finance team, they might have some redundant roles there. Now, looking at some of their selected financial information, there's some nuggets of information that I want to point your attention to here. So first off, the revenues, they grew 138%. That's pretty impressive. Over the year, it was 122%. Now, the cost of sales increased by 151%. Notice this is faster than the revenue growth. And same thing for the year, it increased faster than the revenue growth. Gross profits increased by 90%, which is slower than the revenue and the cost of sales for the year, and 121% for the quarter, which is again less than the revenue and the cost of sales. The expenses ballooned by 241%. And for the year, the expenses increased by 149%, outgrowing the revenues as well as the gross profit. So as an investor, this may be a little bit concerning, or I guess it is a little bit concerning. On the other hand, the company is buying software companies. So typically when you buy a software company, the cost of sales for that company is typically low because your costs are like your databases and certain support stuff. But the expenses of a software company is basically where the kicker's at. To employ all those engineers to program stuff, that's not going to be included in the cost of sales. That's going to actually be included in the expenses. And revenues and gross profits should take off when the economies of scales as well as the network effects work out for those software platforms. For now, they're probably relatively small and they haven't yet hit that scaling phase, or they're just starting the scaling phase. So as CloudMD scales over the next couple of years, I'm hoping to at least see revenue and gross profits increase faster than expenses. So we're here in the income statement, and we can see all the expenses laid out. Sales and marketing basically doubled. Research and development more than doubled. So that's probably all of their like software developer costs, which is expected. The general and administrative has more than doubled as well. Share-based compensation increased by almost double as well. Amortization of intangible assets increased significantly. That's probably because they purchased a lot of assets and those have a lot of amortization. They also have depreciation of property and equipment, so all their clinics and stuff that they own. And they've more than doubled their clinics this year as well. They had financing related costs, which are one-time expenses for the most part. And they had acquisition related costs, which are basically one-time for those acquisitions. CloudMD slows down on its acquisition activity or completely stops it next year in 2021. Then this acquisition related cost will go away completely. It's not required to support the business, so I would pretty much discount this cost as well as the financing related costs in the total expenses going forwards for the next year. So if we subtract the financing related costs and acquisition related costs from the total expenses, because these are non-recurring costs, then they only increase their expenses by about 215%. Now looking at the charts for CloudMD, it looks like there aren't too many interesting things happening here in my opinion. It's a bit of a mess in the past couple of months. However, we did see this wedge that was over here at one point. It broke above the wedge. However, the stock decided to take a tumble. I believe this huge drop in the stock actually came after the latest round of financing, where we saw that the CEO sold off around 30% of his shares. And that was a bit of an alarm to me as an investor. And I'm not so sure how bullish I am on the stock in the future. Currently, right now, I'd say I have a neutral outlook despite these quarterly earning reports, just because the CEO Hamza decided to sell out at around 280. And ultimately, that caused the stock to drop all the way down to lows of around $1.70. And in fact, Dr. Hamza actually did start buying back into the stock. So it's kind of weird. It's like he knew that the stock price was relatively high at 280 and decided to sell shares in that round of financing. And then he saw those shares drop so dramatically, he thought that the retail investor base would be able to hold up, realizing that he sold off a significant portion of his shares. That was not the case, so he decided to buy back in at a lower price. So I'm not really sure what's going on there, and to be honest, that's why I'm a little bit iffy on CloudMD these days. In CloudMD, looking at their market cap, it's around $336 million. If we do some math to find the number of shares, we can see that there's about 163 million shares. And Dr. Hamza owns about 3 million shares. I know he had about 4 million before he actually sold off his significant portion, so let's just say he's about 3 million now. That means he probably owns about 2% of the company. And for a CEO who only owns about 2%, I wouldn't say he's like that aligned with shareholders. Going to a Reddit thread here, we have a response from Investor Relations regarding Dr. Hamza selling some shares. So basically, it says about 10 years ago, Dr. Hamza funded the growth of his business, and since going public 3 years ago, he has not increased his salary, taken a bonus, and still holds the majority of his position. He still sold a fairly large position at around 30%, which I would say if he sold 10%, I would give it to him, but 30% is a little bit too much. It looks like Dr. Hamza needed some sort of liquidity in order to deal with personal tax-related finances. Selling into the finance was a strategic decision regardless of the discount. So that's basically his reasoning for selling some shares. So my final thoughts on CloudMD. So although Dr. Hamza did sell out of his shares, I think at the end of the day, CloudMD's business is, seeming to grow right now. They have a lot of growth in their top line. However, it worries me that their expenses, as well as their cost of goods sold, are ballooning as well. I'd like to see a few more quarters out from now to see if expenses are continuing to balloon like they are right now. For now, I say that management seems like they're fairly confident that they can continue to execute well, and they do have a lot of cash on the balance sheet. So for the interim, they can sustain these huge losses that they have been doing in the short term. But eventually, they're going to have to either raise more money, which will dilute shareholders, or they're going to have to turn a profit. In addition to this, there seems to be a decent amount of bearishness regarding telehealth stocks as well as just health tech stocks as the pandemic seems to be winding down and society is going back to normal. So I think there is some sort of short-term headwinds in terms of the stock price, but if you have a longer time horizon to hold CloudMD, I'd say your chances of an upside are definitely more like 60 to 70% versus the downside, which is 30 to 40%. Anyways, that's all for CloudMD's Q4 earnings. I'd like to hear your thoughts in the comments. Did CloudMD exceed your expectations? Were they underwhelming? Or were they just neutral? And what's your outlook for CloudMD? Are you bullish, bearish, or neutral like me? I've got 2 other videos on the screen about CloudMD. If you're there, I'll see you there. If not, keep up the grind and have a great day.